Good afternoon to our CLA family members, clients, community partners, and friends. Welcome back to our live stream. We sincerely hope that you're continuing to stay safe and healthy at this time. We also appreciate all of your questions and interaction that have come through the inbox at livestream@claconnect.com. The questions are awesome, and we are monitoring and responding to them daily. So keep them coming throughout the session today, and we will do our best to address as many as we can while we're live with you today. We would also like to remind you to visit our COVID-19 landing page at claconnect.com for up-to-date information about these programs, tools, and ways to connect with us for more specific consultation. So today we have a jam-packed session. I would like to introduce all three of our guests. First of all, we have Brian Ream from our CLA Wealth Advisory Group, and he will be giving us a market and economic outlook update for us for the second half of the year. So welcome, Brian. Additionally, he's going to answer a few questions for us about the current economic climate. We also have our beloved Jack Rybicki back to talk about some of the PPP questions that have sprung up from last week's session, and also some new economic relief legislation related to nonprofit organizations. So great to have you back, Jack.
Hey, Ainsley.
And finally, we welcome back Scott Hess to talk about pertinent items related to Form 941. So welcome to the three of you. We are thrilled to have all of you. And with that, we have a ton of ground to cover today, so let's dive in. So Brian, I'd like to start with you and talk about the market and economic outlook. And I know you're going to be covering this in depth here, I think, on July 21st, but maybe you can just give us a little bit of an overview and start with some of the key points that you're going to be covering today. I know it has just been a wild year for us, but maybe what you can do is give us a recap of what you have seen so far in the market and economy for the first half of the year.
Yeah, thank you. Yes, definitely 2020 has left nothing to the imagination. We have kind of come full circle. You know, we started out at the beginning of the year coming off of a very good 2019 with a lot of strong momentum, and then February, March hit. We saw a peak to trough decline of about 35% over that period of time, and then quickly the federal government came in and kind of provided an unprecedented backstop for not only the equity markets, but the fixed income markets. So interesting year in that this was really the first time we've kind of manually turned an economy off, and then quickly came in to backstop that decline. From there, we began recovery. March 23rd was when the Fed took its, pretty much the $2.5 trillion backstop for the economy. And from there, we slowly started to improve in the markets. We had the passing of George Floyd in March. So you layer on now social unrest, the Black Lives Matter movement, et cetera, defunding the police. We've got kind of a disrupted social environment in the United States. Really has, as I said, left nothing to be desired through the first half of this year.
Yeah, and so I think, it has been a wild ride, a lot of ups and downs. People are all sitting there scratching their heads, though, because I think they've seen the market kind of go like this, but, they're all sitting here really scratching their heads as COVID starts to spike back up and really just kind of wondering, where do you really think we're at now?
Well, that's the $64 million question. We really have come full circle in the stock market, having basically fully recovered as of the 15th close last night. We were basically back to where we were in January 1. I think what everybody is wondering is you seem to have this massive disconnect between what's going on in Wall Street and the stock market and Main Street as represented by our general economy. And there's no question right now that this market seems to be trading on a lot of hope. So what I mean by that is markets tend to look forward and be a forward pricing mechanism. Where are we going to be in approximately 6 months? And there's no question right now that the market is trading on hopes of a vaccine. We've gotten some really encouraging news, and there are actually several trials currently underway. All of them seem to be having some traction, but that doesn't distract from the fact that earnings visibility is still very opaque. A lot of companies have basically stopped giving expectations or where they think they're going to be in the coming quarters. And later on, right now, we're just beginning Q2 earnings, and it's been a very mixed bag. This has become a market of very clear winners and losers. Haves, without question, are somebody's calling me. The haves very clearly, big tech, right? We know the cohorts: Facebook, Amazon, Google, Apple, Amazon. These are the stay-at-home COVID stocks where everybody has been chasing and providing a huge amount of momentum. On the other end of that spectrum, however, energy, financials, just about every other sector in the S&P 500 hasn't done very well or is pretty dramatically underperformed. So we're expecting, as we go through Q2 earnings, we're going to see a lot more of that theme. Nordstrom's is probably not going to do very well. Amazon will expect fine earnings from. So on top of that, we have been seeing some very encouraging signs. The weekly unemployment claims came out this week, a little better than expected. The current unemployment numbers, a little better than expected. We're getting a lot of encouraging news that's a little bit better than expected, but it's kind of like a patient who's been in a coma. When they first open their eyes or they wiggle their finger, that's wonderful. That's great progress, better than expected. However, far cry from where the economy was prior to COVID. So indications look okay, getting better. However, as you mentioned, we are now entering this, I hate to call it a second wave. I would rather call it, in my mind, it's more of a forest fire where we have things kind of explode and then go down to a smolder. My guess is that we're going to see this continue to smolder. I don't think it's going to go away as quickly. And we'll see how that continues to play out in the second half of this year.
Yeah, so I mean, I'm glad you bring that up. Certainly the second half of the year has a lot of things that we think will happen, i.e. the election, for example. So what do you see on the horizon for the second half of the year, knowing that there's some big events that are going to happen?
Well, there's a lot of questions about where the market is right now, back to where we were, despite the potential for this reemergence in cases of COVID, in spite of this opaqueness in being able to accurately forecast or really get down to the fundamentals of where stocks should be priced. The other side of that pillow is, what's the alternative, right? There's a lot of conversation around, realistically, interest rates are at zero and the Fed is not moving off zero anytime soon. So if that's the case, where am I going to go for yield? 10-year Treasury has been steady at about 0.6%. S&P just dividend yield is around 1.8. So you have a lot of kind of grassroots money that's been flowing into the market simply because they're chasing yield. What we call the old TINA market. TINA is there is no alternative to stocks. So we think that might provide kind of a ground level of momentum for equities as we go into the second half. The other big question marks: stimulus round two. The CARES Act, we know, has come in and created a tremendous amount of income for those currently unemployed, $600 a week. However, we have 9 more days of the CARES Act. There's definitely conversation from a policy perspective, from a fiscal policy perspective, of what does a second round of stimulus look like? If we have this fire kind of roar back up as far as number of cases, what is going to be the impact? Are we going to go back to a stay-at-home order? Or are we better equipped now with plexiglass in our retail locations? Lots of questions around that. Let's see. Do we have a tremendous wave of bankruptcies? CARES put a kind of an artificial floor in place, but did we just kick that can down the road? When we looked at the bank earnings that started rolling out at the beginning of this week, we saw loan loss provisions at our banks have blown up. We're at about $28 billion set aside in the banking system to basically start to prepare for what might be eventual debt crisis down the road. So a lot of things on the horizon, not to mention the election. We've been distracted by so many things in the first half of this year. The election's 4 months away. The amount of variables that are going to go into this 2020 election, it's going to be unprecedented like the rest of the year. We have a couple things that we haven't experienced in the past. For example, we know in 2016, all of the polls had Hillary winning. Turned out all the polls were wrong. But how do we even try to garner information for polls now that everybody in the last 4 years have moved to cell phones? And I don't know about you, but if I don't recognize the number calling me, I don't answer it. And since most polling is done over the phones, there's going to be a lot of opaqueness around polls, exit polls. If we're voting by mail, am I going to be able to garner information from an exit poll? And then the voting by mail introduces just a few potential legal challenges, despite who the winner is. I think we could be looking at another Gore versus Bush type of election where we may not have the results the day of the election, but it may be weeks or months after until things get contested in court. So one thing we can count on for certain, expect volatility to probably increase as we approach the election. So we want to be aware of that. And what we're kind of coaching our clients to do is look at your allocation and stay the course. We're going to continue to focus on high quality companies with steady earnings, low debt, good cash flow, those that are positioned to weather this as best as they can. On the fixed income side of the balance sheet, we want to look at basically higher credit qualities. Again, not necessarily ready to dip our toe into some of the murkier ends of the debt market. So that is a whirlwind amount of information.
Well, it certainly was, and it's been a whirlwind of a year, so we really appreciate just you popping in for that brief update. I know you and Clayton are going to spend a lot more time on this next Tuesday, July 21st at 3:30 Central, and so again, we just appreciate you coming in and giving a snapshot. It was very helpful. And now with that, I'd like to pivot and bring in Jack Rybicki. Jack, it's great to have you back. We always appreciate the updates that you have related to PPP. And there's also been some new guidance this last week as well related to nonprofit organizations. So Jack, let's start with just some clarifications around the PPP last week. I know you've gotten some questions, and I'd like you to clarify some of the topics that have been raised, if you wouldn't mind.
Sure. Thanks, Leslie. And it's great to be back with everybody again. We did talk last week. We got a few questions about whether or not you have to include all of your costs on your PPP forgiveness application. And a lot of those questions were really in the context of, well, if I can make it using my payroll, do I have to include utilities and rent and other things? And the answer is no, you don't have to include all the costs that you've incurred during the covered period. The application itself even says very specifically, you only have to include those costs that you are asking for forgiveness for. But we did start to get some questions about, well, what if I can only use part of my payroll? So I have administrative payroll, and then I have a separate hourly payroll. But I know if I just use 24 weeks, I can make it with my administrative payroll. Do I have to include my hourly payroll, for instance? Because that's more problematic to track. The FTE calculations are more complex, all that kind of stuff. And so, you know, the guidance that we gave out last week was, well, technically, again, you don't have to include all of your payroll either. It doesn't say you have to. But I think I didn't clarify maybe enough on that. And so that's really what we wanted to go through today. The one thing you have to remember, if you are going to try to pick and choose payroll costs, right? The FTE test, so if you are subject to the FTE reduction test, the FTE test is going to compare your number of FTEs during the covered period to one of your 2 or maybe other pre-COVID periods, right? Mm-hmm. So your denominator is always going to look at your entire company, right? So let's just say you had 50 employees that were hourly and 25 that were salaried, and you paid them on different cycles, and you were only going to try to use the 25 salaried employees to get to your loan forgiveness amount. That might work from a dollars perspective, particularly if you went to a full 24 weeks, right? So that might get you there from a dollars perspective. However, what you have to think about is, what's that going to do on my FTE reductions? So if you can't answer the question, I didn't have any reductions, and therefore you have to apply that FTE reduction test, if we think through that in its simplest form, you'd have 75 FTEs in total during one of your 2 pre-COVID periods. But if you only used your salaried folks, the 25 people, you might only have 25 FTEs that you're measuring, in your form. As a result of that, you might have an FTE reduction quotient, even though you didn't include the salaries of those people on the thing, on your application, because you're only reporting for a third of your employees. And so you could be hurt by not including them, even though they might have been fully employed during that time. So there's definitely a balancing act that you would need to do. And the more we thought about that, particularly with the flexibility we have to file early, we would think that on payroll in particular, it would be better to use all your payroll during a shorter period of time rather than some of your payroll during a longer period of time. We think that would, eliminate the potential for issues in that filing process. So, that was just a point of clarification that we wanted to get out. I know people are starting to get a little nuanced in their planning, particularly in the situations where, if the IRS doesn't come back with new guidance around the deductibility of expenses, or Congress doesn't come over the top of them and eliminate that issue, I know people are starting to think about, well, which things should I include in forgiveness and which ones shouldn't I include? Or, we're seeing our nonprofits and other groups do the same thing. Can I exclude certain people who are reimbursed under federal contracts and then only include those folks for PPP forgiveness that are not subject to reimbursement? Again, you potentially get into issues with your FTE calculations when you do that. And so while there is some potential planning to be done there, it does get a little more complex, particularly if you're bifurcating your payroll.
Those are really great clarifications. So thanks for providing that. As usual, there's a lot of moving pieces with that, and it's good to think holistically, I think, about everything. So let's also talk for just a moment here about the new bill that Congress passed that's really targeted towards supporting cash flow for nonprofits. So tell us a little bit about that.
Yeah, so first of all, I want to clarify, this is just a bill still, right? So my understanding is that it's on President Trump's desk for signature now, but that it has passed both the House and the Senate. And so the name of this bill is the Protecting Nonprofits from Catastrophic Cash Flow Strain. They don't have a cool acronym for it yet, so I have no idea what to even call that one, but we'll just call it the nonprofit bill for now. But so many nonprofits got into a situation because they fund unemployment benefits using they're called reimbursing employers. So they don't pay unemployment insurance along with the normal course of business like a for-profit entity could do. They have the ability to elect this other method of funding their obligation, And normally what they have to do if they are a reimbursing employer is they have to pay 100% of the costs associated with their former employees that file for unemployment. And the good thing is, this usually ends up being a cheaper method for nonprofit organizations. So they don't fund on everybody, they just fund on actual claims effectively, right? The CARES Act realized that given everything that was going on, that nonprofits were likely going to get hit pretty hard if they were in this reimbursing employer bucket. And so as a result of that, the CARES Act set aside some money and said that the federal government will step in and fund 50% of that obligation for those reimbursing employers. However, the Department of Labor interpreted this kind of in an unusual fashion. And what they said is that the nonprofit organization has to pay the state 100% first. And then when the state receives the funding from the federal government, the state would reimburse the nonprofit. So essentially, they shifted the burden of 100% of the unemployment benefits to those nonprofit organizations that were already strapped for cash to begin with, right? Because they're seeing, donations go down, fundraisers go down, all that kind of stuff. So this bill, what this does is it actually says states, you don't have to do that. Nonprofits, you only have to contribute 50% that you're ultimately going to be on the hook for, or you don't have to contribute the 100%. And the government hopefully is going to reimburse the states a little quicker for that. Now, I will say that the states treated this inconsistently as well. Some states realized the burden that was going to be placed on the nonprofit organizations. And so we did see certain states had great programs where they were deferring payment for the nonprofits under this to help them through this period of time. But that was inconsistent. That was being done state by state. So this bill, if it does become law, will be consistent across the United States then, and will give definitely some relief to employers or to nonprofits that are these reimbursing employer type arrangements.
Well, thank you so much for just providing that overview. I know we have a lot of nonprofits that listen in, and certainly that will be really helpful for them. So we really appreciate you popping in for these updates. We are now going to bring Scott on because we have a lot of just updates and questions we've been getting related to 941s. And so, Scott, it is wonderful to have you back. We would love it if you could just give us a little bit of a refresher to start out on some of the payroll provisions related to the CARES Act, as well as the Family First Coronavirus Response Act.
Yeah, you bet, Leslie. Thanks. And it's great to be back. So exciting times. We've got a new 941, and it's finally time to report all that Q2 payroll activity. So including all those credits you just mentioned under Families First and the CARES Act. So there were really three main opportunities for relief through those acts. So the first was just the deferral of the employer share of Social Security taxes. So that's one thing you're going to have to report on the 941 if you took advantage of that. And that's something that applies to all payroll tax deposits and payments that were due on or after March 27th through the end of the year. And that's going to include deposits that will be due in January of 2021 for wages paid in December. So this is essentially an interest-free loan from the government with 50% of those deferred amounts due at the end of 2021 and 50% at the end of 2022. So initially, we didn't think this would have a lot of widespread applicability because we were limited. Borrowers under the PPP loan program at first weren't going to be eligible once they received forgiveness, but that was fixed with the PPP Flexibility Act. So that removed that barrier, and now really all businesses have the opportunity to defer. So if you haven't done that to date, you can still take advantage of that on a go-forward basis over the remainder of the year.
So long as we all track it so that we can pay it back later, right?
Yep, don't forget about it because that bill will be coming due someday. It doesn't go away. And then the next relief provision we had was the paid sick and family leave credits under the Families First Act. So we saw a lot of widespread application of the family leave credits in the second quarter. So early on, as schools and daycare centers were being shut down and people had to take off of work to care for their kids. We expect we'll see a lot of continued application with the sick leave credits in the third and fourth quarters as we start to see, we're starting to see rising numbers of confirmed cases of COVID-19 across the country. So probably a lot of people that are going to need to take advantage of that 80 hours under the sick leave. So again, the sick leave covers up to the 80 hours. It's going to be at your regular rate of pay up to $511 per day if it's for your own self-care. And then if it's for the care of another one of your family members, it's up to $200 per day or 2/3 of your pay, the lower of those two amounts. And then paid family leave if you're home caring for a child as a result of one of those, school or daycare closings I mentioned. Again, that's also going to be at 2/3 of your pay, up to $200 a day for a maximum of 10 weeks. And then just keep in mind as you're calculating those credits, the qualified health plan expenses and the Medicare tax on those wages also count towards the credit. So then the third relief option we had was the employer retention credit. So again, we saw quite a bit of this in the second quarter as cities, states were all being shut down. I think we may see less of this in the third and fourth quarter as those stay orders are being lifted and the economy is starting to recover. That credit is 50% of the first $10,000 in wages and qualifying health plan expenses for each employee. All employers are basically eligible except for federal, state, and local government agencies, and then any businesses that received a PPP loan. So to qualify, the key is you need to have been either fully or partially shut down as a result of a government order, or have experienced a significant decline in your gross receipts, which is defined as a reduction of more than 50% as compared to the same quarter in 2019. And if you're under 100 employees, the credit is only good for wages paid to employees who are not working. And if you're under 100 employees, it's really wages paid to any employees that count.
Well, thank you so much for walking through those. I mean, certainly, I think those get overlooked a lot because we all flood to the economic relief, but these are really helpful provisions. So now that we've gotten the new 941, maybe you can walk us through what that form looks like and just what are some of the important things that we need to know?
Yeah, so it was in draft form for quite a long time and then finally went final here right before July. So when you take a look at it, it's going to look a lot different than the prior version. We've got more than 40 new lines of information that you may have to fill out when you count all the schedules that are included in the instructions. So you're really going to need a lot more information than you've needed in the past. So starting on page 1, in part 1, they've added lines for this for the sick and family leave wages. So in the Social Security wage area, we need to report those separately because those wages are not subject to the employer portion of Social Security tax. And then just as you're working on that part in particular, keep in mind that if someone's over the Social Security wage base, you don't include those wages in that section. So then if you kind of continue on down page 1, you'll see new lines 11B and C, and then lines 13C and D. So those are for the new credits under Families First and the employer retention credits. And those are really going to flow forward from the new worksheet 1, which is included in the instructions for the form. So you're not going to find that on the form itself, but that worksheet is going to include all the steps that you're going to need to calculate those credits. And then, so that's going to just be something that lives behind the scenes and you're not going to submit that with the return. But the information that you're using in that worksheet, you are going to report some of that information on the new page 3, which is on, or I'm sorry, part 3, which is on page 3 of the form. So that's where you're going to have your qualified health plan expenses that are related to those FCNR and employer retention credit wages. So, and then further on.
Okay.
Go ahead, Leslie.
Sorry.
Yeah, no, I was going to say, then further on in part 1, you're going to see 13E and 13F are other new line items. And that's where you're going to report those Social Security tax deferrals and then the advance credits that you may have claimed on Form 7200. So a lot of additional detail that's needed if you did take advantage of any of that relief. And if you didn't, the form's going to be pretty simple. You're just going to skip over all that stuff.
And I was just glad you brought up 7200 because I was actually going to bring up the fact that the IRS has talked about just this week, actually, that 7200 has seen some delays and issues with processing. Is there anything that you want our viewers to know related to the delays and issues that have come up with respect to Form 7200?
Yeah, nothing in particular other than be patient. Those Form 7200s had to be filed on paper. The IRS is behind on a lot of their paper filings, so, just a few best practices as we're going through this kind of related to that, just be aware the IRS is finally starting to catch up on processing the Q1 returns. And so if you took advantage of deferrals in the first quarter, the IRS didn't have the forms updated by then. So if you filed it, it looked like on paper that you owed money, but you didn't. And they're finally starting to get notices out on that. So it's a pretty simple fix. You just will need to contact the IRS or write a letter to get that cleared up. And then just a couple other real quick tips. I know we're getting close to time. If you had qualifying employer retention credit wages in the first quarter, don't amend your first quarter return to take advantage of those. Include that on the second quarter return. If you find out after the close of the second quarter here that you qualified for the employer retention credit, but you already filed your second quarter 941, don't worry, you can go back and amend for that and claim those credits. And then lastly, on the Social Security tax deferrals, keep in mind that deferral needs to be made at the time of the deposit. You can't go back and do that after the fact. That's only on a go forward basis. So just as you're preparing the form, be organized, have all your information ready at your fingertips. Make sure you have a basic understanding of the mechanics of those credits. There's a lot of good resources, FAQs out on the IRS website to help you with that. And then just reconcile the return you've prepared with your records. Make sure it is coming out the way you expected. So a lot of complexity. 2020, it's probably never been a better year to outsource your payroll.
We really appreciate you bringing those timely updates to us, so thank you. And unfortunately, that is all the time we have today, but I do want to thank Brian, Jack, and Scott for the fantastic discussion and timely update. I want to thank all the viewers for all of your questions and all the moderators who have been in the live stream inbox for all of their support and information and answers. So we will be back next week on Thursday with additional updates as well as a deep dive discussion on the impact of COVID legislation on the education system and changes you can expect in the current economic situation. So please, again, feel free to send questions in advance of that session, and we plan to cover what we can when we're together. We'd also like to close just reminding you to continue to visit our COVID-19 landing page at claconnect.com for more information on PPP forgiveness as well as other hot topics. We would like to remind you we've got our forgiveness tools there as well as other information. And with that, just continue to send you our questions and we will see you next week for more information. But until then, stay safe, continue watching, and have a wonderful weekend. Bye for now.
Thank you.
Thanks.